Hey everyone, today we're jumping into a really cool what-if scenario. It gets right to the heart of personal finance and explores what I like to call the almost magical power of compounding. So let's just start with a big, juicy question right up front. Can $200 a month actually make you a millionaire? I know, it sounds kind of crazy, right? Well, in this explainer, we're going to unpack the numbers and see what's really possible. Okay, first things first, let's get our baseline. If you save $200 every single month for 25 years, you'd have put away a grand total of $60,000. That's your own money out of your pocket. Now keep that number, 60,000, in your head. It's going to be really important in just a minute. So what happens when we take that consistent 25-year habit and we mix it with a high-growth investment scenario? This is where it gets fun. Let's unpack the numbers and see just how a small, steady habit could, believe it or not, lead to a massive outcome. All right, check this out. We're looking at two different possibilities. In our base case, we're assuming a really strong 15% annual return. After 25 years, your 60 grand turns into almost $650,000. I mean, that's amazing. But look at the Blackstone Level scenario. Just bump that return up to 18% and the total value absolutely skyrockets to over $1.1 million. You did it. You became a millionaire from just $200 a month. And wow, this chart just lays it all out, doesn't it? On the left, you've got a fantastic outcome. But on the right, that's a life-changing outcome. And that huge gap between them, that's almost $500,000. And it all comes from a tiny little 3% difference in the annual return. Just let that sink in for a second. We're calling this the compounding effect on overdrive. See, the really crucial thing to understand here is that a seemingly small 3% increase doesn't just add a little more money on top. Because of compounding over time, it nearly doubles your final outcome. It's not addition, it's multiplication. Your money starts working exponentially. So what's the financial magic that's happening behind the scenes here? Well, it all comes down to one incredibly powerful idea: the compounding snowball. So what is compound interest, really? It's pretty simple. It's when your earnings start making their own earnings. Think about a tiny snowball at the top of a really long snowy hill. At first, it barely picks up any snow. But as it rolls and gets bigger, it starts picking up more and more snow, faster and faster, until it's a giant boulder by the bottom. And check this out. This timeline brings that snowball effect to life. In the early years, year 5, for example, the growth feels kind of slow while you're building that initial base. But look at the incredible jump between year 15 and year 25. That is the turning point. The most explosive, mind-blowing growth happens in those final years, when your snowball is massive and it's really picking up speed. Okay, this slide right here, this is what really gets me. On the left, that's what you put in, $60,000. And on the right, that's what your money earned for you in that 18% scenario. Over $1 million in pure profit. The real workhorse here isn't your monthly $200 contribution. It's your earnings working for you 24/7. To pull a quote directly from the analysis, at 18%, your profit is more than 18 times the amount of money you actually put in. That is just a staggering force multiplier. Think about it. For every single dollar you invested, the market gave you back $18 in pure profit. Wild. All right, so I know exactly what you're thinking at this point. This all sounds absolutely amazing, but is it just a financial fantasy? Well, it's time for a reality check. Is this kind of performance actually possible for an average person? So yeah, let's tackle the elephant in the room. Can an everyday person really get these kinds of consistent, high-level returns? The short answer is it's extremely difficult. And here's why. You run into some pretty big roadblocks. First, the top-tier private equity funds have traditionally required you to invest millions just to get in the door. Now, even some of the newer products for regular folks might have minimums of around $2,500, and they often require you to be an accredited investor, which basically means you already have a high income or net worth. Plus, your money is often illiquid, meaning it's locked up for years. You can't just pull it out tomorrow if you have an emergency. And, just to put this all in perspective, the historical average return for the S&P 500, which is kind of the benchmark for the whole U.S. stock market, is closer to 10%. So these 15 to 18% returns we've been looking at are truly exceptional, and they're incredibly hard to keep up for 25 years straight. So if getting these exact returns is such a long shot, what was the point of all this? Well, that brings us to the most important takeaway of all. This was never really about one specific investment. It's about the universal lesson we can all learn from this powerful example. The real lesson here isn't to go out and chase some super high risk investment. No, it's about the universal power of the two things that you actually have control over: time and consistency. The math of compounding works its magic whether your return is 18%, 10%, or even 7%. The longer you stay invested, the more powerful that snowball effect becomes. So we'll leave you with this to think about. Forget the specific numbers for a second. What is one long-term, consistent habit you could start today to get your own financial snowball rolling down that hill? Because the sooner you start, the bigger it's going to get.